What I want is I want bad decisions. I want bad buys, bad purchases to be punished.
Yes.
I am I am I am someone who called his shot early. I've been somebody who's repositioned capital because I've seen the movie before and I want to strike when there are deals. If you've been following my daily financial news, you know we've been talking about the single family home market slowing down. We've got record transaction low at 3.89, almost breaking the cycle low of 3.88. Then you've heard me talk about perhaps a recession ultimately being called or flagged in June or July of 2024. Of course, we won't know about that until Q1 or Q2 of next year. But the last thing we started to see is the 10-year note is dropping. We're actually seeing also some compression, yield compression between the 10-year and mortgages. It is starting to feel like rate cuts in September are not only certain, but perhaps larger than people expect. Again, we're going to talk about what this all means because it may just be another head fake. But Jonathan, it's wild out there. The last time I checked the Fed tracking tool, it was 100% chance of a September rate cut. What do you make of all this?
I mean, listen, I feel like we've been down this road before, right? And uh, I mean, we're either going to be in a situation where, broken clock is right every 12 hours, or, where it's going to be another big head fake and the markets are, kind of getting ahead of themselves on wishful thinking. Certainly, there seems to be some softening in the economy, but the I don't know if, going from 3.6% unemployment to 4.1 unemployment, which is still below full employment, really means we're going to get a massive rate cut like some people are predicting. But I'll tell you, the chatter is just going wild, where everybody now is baking in a rate cut, potentially a big rate cut. They're all kind of like, rubbing their hands together in anticipation of this. And I I still remain kind of skeptical about it. Feel like we've been here before. If there is a rate cut, I think the Fed is going to be cautious about it. I don't think they're going to drop rates drastically right off the bat, because I do think that they're still concerned about reigniting inflation. So I think if we do see a rate cut, it'll be, uh, you know, something pretty moderate.
Yeah. It is really interesting because I look at the data every day. I have a daily show that goes live 5 days a week. And the economic data, which absolutely is backwards looking. So believe me, I understand. And also I understand the revisions are predominantly negative revisions. But again, if you take the Fed at their word, which, I understand is an assumption, we just today we got GDP for Q2, the first report, and it came in higher than expected. It came in at 2 points. Real GDP
Yeah.
came in at 2.7, right, which is a healthy growth rate for our economy. Then we had the weekly unemployment rates, which this week was an important one because during the July 4th week, it spiked to 243, right, which would have been another step up, right, because we were at 200 and then 210 and then 220. But thankfully, after we've removed the July 4th noise, they came in lower than expected this week at 235. So we kind of stayed where we were. It's not getting worse, right? It's not taking the elevator up. We've got PCE reading tomorrow, which, based on the back of the napkin math on PPI and CPI is going to be a nothing burger, right? It's trending lower, maybe slower than you ought. And then if you go and look at Trueflation is something I look at probably once a week. It is now saying, based on 5,000 real-time metrics, that the Fed is one.
Mm,
Inflation today, according to Trueflation, is 1.75%,
wow.
below 2. So, you know, the Fed can, if it wanted, declare victory. Unemployment, right? Full employment. They could rub their hands together and say, "Great, soft landing. We're here. Let's party." It's wild.
I, yeah, and so with all of that said, I guess I remain, maybe at heart, I'm more of like a hard money guy, or whatever the
Sure.
phrase is, right? So, or, you know, so maybe that's my bias, but I feel like if they've won, right, and the economy is kind of on cruise control at the moment, then what's the justification for
Yeah.
cutting rates?
What's the
Doesn't-
rut? That's where I go, right? If
Yeah,
you're looking at these numbers,
yeah,
there's not a number that I just went through that says cut. And oh, by the way, there's certainly not a number in there that says cut big, right?
right.
There are people talking about 75 basis points in
Yeah,
September. Where
yeah.
did that come from?
I I think it's wishful thinking. I mean, we should, you're kind of more on top of like the economic indicators than I am, but I, when was the last time the Fed cut by 75 basis points? What were the circumstances? I'd be willing to
Oh, it's a
guess,
pandemic. Absolutely. The
right?
pandemic
I'd be
was the
willing
last
to
time.
guess that a cut that big is because the Fed is like seeing some dark storm clouds on the horizon, right? Or it's
No,
already,
it's so no, it's here. When the Fed cuts 75, it's a reaction to something. So we're not talking storm clouds on the horizon. We're talking about storm clouds overhead, right? Um, that
so
yeah, dude, a 75 cut is. I mean, here's what I think. Let's just pretend for a moment because I'm with you, right? This is the market telling us in January that 6 or 7 rate cuts are coming. It's
right.
kind of the same thing. But let's just pretend for a moment that they get to September and they do cut by 75 basis points. You know what I think? I think, holy shit, what the hell do they see that I don't? Because
Right.
something is nasty out there.
Yeah. Yeah. I mean, the only reason that I could kind of imagine why they would cut rates, frankly, at all, but especially by that much, with all this economic data that you've just talked about, is that they're really worried about corporate bankruptcies, right? And they think that like that they really need to give corporations a a a break on their debt service, um, or maybe the banks, right? They want to give the banks a break from all this commercial property out there that can't get refinanced or whatever. Like maybe that would be their thinking, except I think they would really be wary about reigniting inflation, reigniting asset bubbles. I mean, the
Mhm.
stock market does not need a rate cut
No,
right now, right? You know, and so it's it, I find the whole idea a little bit mystifying. But I think, and as I've been saying for a long time, I really think that, I've acknowledged like my kind of cognitive bias as somebody who prefers rates to be higher. So that
mhm,
obviously like impacts what I say. But
sure.
I think a lot of the people who are stumping for a 75%, sorry, a 75 basis point cut are not really acknowledging their own cognitive bias, which is that they've lived their entire professional career in an ultra low interest rate environment,
Mhm.
and they can't comprehend the idea that interest rates this at this level are just normal, right? And that the economy can function perfectly fine with rates at this level and has performed with rates at a much higher level. And historically, when the economy did well, rates went up, right? This is like economics 101, right?
Yeah.
Just go up because there's more demand for money, right? So the whole idea that like the economy does well and rates go down, I mean, this is kind of like a new, I mean, I guess it's been going on for a while for the last 20 years, but it's sort of like in the grand scheme of like economics, kind of an unusual thing, right? So,
Mm.
um, but
Yeah, I think there's just a lot of people, and again, I go back actually to the Jackson Hole Powell talk, which is now almost 2 years ago he did this, right? Which kind of started this rate increase cycle. It was in August of 22 he did this. And he basically ripped up his speech, threw it out, and did a 4 minute or a 3.5 minute talk that basically said, we're going higher. Enough of this nonsense. And I still believe Powell wants to break the Fed put.
yeah,
I don't think Powell looks at what the stock market is doing and is particularly influenced by it. He's like, you guys have been wrong this whole time. You're just wrong again, right? We're
yeah,
not we're not cutting 75 basis points in September. And again, I go back to the point, if they do, be careful what you wish for,
yeah,
because that means a nasty recession is like at our doorsteps.
yeah. And I think frankly, it will ignite another bubble if they do. If they were to cut that big, you would immediately see a commercial. I mean, the stock market would go into like an insane bubble. People already say it's in bubble territory, but like it would go into an insane bubble if rates were cut, and real estate would just inflate another bubble, which obviously is what most real estate people want, right? Because they don't know how to make money, the old-fashioned way by earning it, right?
Yeah,
Remember those?
by adding value and doing the hard stuff. They want
Yeah,
they
it's
want
like
financial engineering. Yeah.
They just want low cap rates that, the greater fool, they're always being a greater fool, right? So if they knew what they were doing, they would love this environment because it's just so much easier to buy good deals, right?
Yeah.
But um,
Yeah,
I
let's
also
let's talk about go ahead.
I just want to say, like, sort of one of we can circle back to that, but one other thing is, just on the Fed's, intentions. If we talked about, remember we're talking about stock buybacks a while
Mhm.
back. I mean, we
Yep.
talked about it a lot a couple of years ago. I mean, think about like the situation in which all these companies gorge themselves on debt, right?
Mhm.
They didn't create any value with that debt. They just bought back stocks to pump up the stock price. Now their debt service is higher, and they didn't invest that debt into creating new cash flows that could service the debt that they now have,
Right.
right? Like if the Fed cuts, all it does is reward that behavior again. It's like it's a different version of the Fed put, right?
Mhm.
But it's like basically
Absolutely.
rewarding companies for just gorging themselves on debt.
Malfeasance. Yeah,
Yeah.
malfeasance. Yeah.
Yeah. And frankly, if you want to get like, tinfoil hat stuff, for all the people who say like, oh, the Fed has to cut rates to service the federal deficit, you could look at it the other way around with
Mhm.
maybe the Fed is saying, hey, Congress, you should get your shit together because we're not going to enable you anymore, right?
Yeah, which Powell has basically said a couple of times. He's like, "Hey, that's not my problem."
Yeah,
Right?
not that we have to accommodate you, but you
You,
better get your act together and start like reining in the spending
yeah.
because, we're not going to make it easier for you anymore.
Yeah.
So, you know,
Yeah, it's really weird because again, I look at this and I try to piece it together. The one area that I can look at today, even with all those economic metrics that we talked about, and I could see a rate cut. And again, I've struggled with this, is this thing called the terminal rate that's sometimes called R star.
mhm,
And that's basically somewhere between a fictitious and a guess on a neutral interest rate.
right,
And where I go with this is if truflation is right, 1.75% versus the government's 3% inflation, that's one and a quarter. And if we can acknowledge that truflation is a far more up to date and timely metric, which over the last year they've been a lot more right than wrong, good for them. So the model is working. There is room to cut and stay neutral because what happens when inflation drops and you keep the terminal rate at today 5.25 to 5.5, the environment gets more restrictive, which eventually becomes a problem. That's the only thing where I look at this going, you know what? I could see that. If we really want to claim victory on inflation, if it's now, let's call it 2%, not 3%, if we drop rates a 0.5%, we're still tight, but we're less tight. I mean, that's the only thing I can look at this and go, and I think that's too much gymnastics and, stand on one foot, touch your nose. I mean, it's like all of these variables, but that's the only one I could think of.
yeah. I mean, anyway, doesn't that what you just said? Doesn't that actually argue in favor of cutting when it actually does become restrictive, right?
Yeah.
As opposed to like anticipating that maybe it's going to be restrictive some point in the future that you really can't pinpoint, rather than like trying to cut in anticipation of that without
Yeah.
reigniting all the problems that lower rates cause. Why not just wait until the data shows that it's overly
Yeah.
restrictive and then cut, which is typically what they do, right? That's sort
Yeah,
of what.
the only soft landing that the Fed has successfully done, often talked about, I think, was 1991.
Yeah,
And in that environment, the problem with R stars, it's not a mathematical, it's opinions, it's best guesses, it's ranges. And if they try to feather this thing to like on a glide path, they would cut early. They wouldn't wait because if you in economics, if you wait too long, right? If you wait till the data is right here, it's
you
too
miss
late. The
right.
data is going to because of lags, right? It takes time. So again, I don't see it, but I mean I talked about it like 2 weeks ago when the Fed tracker said 100% rate cut, and now it's not only 100% rate cut, but there are people talking 50 and 75.
Yeah,
I just don't
I,
I
I
don't
don't
get it.
I don't see it either. I think it's wishful thinking. And I think I mean, listen, on this whole neutral rate debate, right? Uh, like, how do we know that we're not at the neutral rate right now? It seems pretty
Yeah,
neutral to me. Like, the economy is kind of chugging along. And
Yeah,
and the data is a little bit like it's kind of wavy, right? Which would suggest that you're kind of like on the right on that verge of like
yeah.
neutrality,
You're
right?
balanced, yeah, or
Yeah,
yeah,
sometimes a bad
I
report,
agree.
a better report. So, you know, this very well may be the neutral rate, and the other thing too is that people just, I think there's just so much, people's memories are so short. You know, we just had an enormous asset bubble, at least in the real estate market, right? I mean,
Mhm.
just crazy asset bubble caused by artificially low rates. Like that's not coming back. If you think that, and so many people got into the market during that time that they think that's normal, it's not coming back, right?
Not normal.
It doesn't, even if the Fed cuts a bit, it's not coming back, right? Those people who bought at the top
Are
just have
done. Just done.
they just have to like psychologically accept the fact that they bought at the top of the market and the market's down and they've lost money. And that's
Yeah.
just the fact. And
Yeah.
like, but you see this in every cycle. Oh, it's coming back. Oh, it's going to bounce back. I mean, listen, I even saw this, not just in the real estate market and after the great financial crisis, but when I lived in Japan, I moved there right after the bubble collapsed. And for the first 2 years I was there, everybody basically, it took 2 years for people to really acknowledge that the bubble collapsed. It's not coming back. This is the new reality. Because for a couple of years, it was like people were just like, no, it's just going to bounce back the way it always has done. And,
Mm.
and so that's like people get anchored to a situation and they don't, it takes time for them to adjust to the new reality. So this is, I think, what's happening.
Yeah, and I want to go back to something you said earlier because I'm trying to get my audience to understand this. I want rates to stay where they are. Frankly, I want them to stay where they are all year.
Yeah.
I still am of the opinion that they'll cut in November, although that that is looking a lot less likely given the chatter. But hey, I'm going to stick to my guns because that's what I do. Um, but I would be okay if they didn't cut all year because what I want is I want bad decisions. I want bad buys, bad purchases to be punished.
Yes.
I am I am I am someone who called his shot early. I've been somebody who's repositioned capital because I've seen the movie before and I want to strike when there are deals. If the Fed cuts 75 basis points, there are some people talking about 125 basis points this year, 2024. That that's going to put a floor under deals
Yeah.
and it's just going to change the psychology. I want the pain to continue building. People are starting to get uncomfortable. It's getting easier to find motivated sellers. And a 75 basis point cut in September makes that harder. I mean, I don't
Yeah.
mean to be crazy, but that's the truth.
No, I'm really with you there. Like I really think that like we have to reintroduce like moral hazard
Yeah,
into the
I
economy,
agree.
right? Because we can't, like you said, the Fed put just isn't good. There's a lot of malinvestment, right? It it winds up, I mean, I really, really believe that um, one of the biggest inputs into the big divide between rich and poor these days is because of the Fed, because
Mhm.
of low interest rates for an entire generation. That, and if you don't understand how this works, like people tend to, they're always looking at the payment, right? Okay, the payment is affordable. The payment is affordable. What they not don't look at is the down payment that you have to come up with, because those low interest rates inflate the price, right? So that 20% that you have to come up with to buy a house just gets further and further and further out of reach for people, even if the payment is staying the same because the interest rates are low. And
Mm.
that's what the problem is, right? That's why so many people can't afford to buy a house. And now, you hear everybody talking about housing has been less affordable than it ever has been because now we're just in this weird period where interest rates have gone up, but the price is not adjusted back down, right? So everyone's saying, oh, well, interest rates have to go down. No, the prices are going to go down. Interest rates should stay where they are. That'll help everybody actually, except for the people who thought they were going to get rich off their house, or were planning, just bought at the top of the market and need to move out soon. I mean, I feel bad for those people, but listen, your house is not supposed to be an investment anyway. It's supposed to be where you live, right? So the and this whole idea that like your house was the key to riches,
Mm.
this didn't exist when you and I were kids, right? This was
No.
a function of the real estate bubble in that exploded in the GFC, and then the Fed just reinflating the bubble right away. right?
Yeah.
Which they should.
I want to poke at that a little bit because I think we are definitely on the same page when it comes to commercial real estate.
Yeah.
Right. I think by some reports, commercial real estate as a category is down 20% already in total. I think there's going to be more pain in multifamily than even office, just given the numbers. But
Already,
here it's not.
it's already showing up.
Yeah. All right.
Yeah.
We called it early, so I like to take a victory lap. But in that kind of talk track, you're actually talking about single family home prices eventually falling. So I just want to poke at that a little bit because that's not where my mind is. But I just want to poke at that because I think my
You know,
audience would love to
well,
hear your thoughts.
yeah, I mean, I do. It may not be like a very rapid, thing, right? That's a sudden and it's and in the short term. But I think if you know interest rates stay where they are, then eventually the prices are just going to have to adjust, right? For affordability reasons. So when the banks are underwriting you, right, whether you can afford it, either. I mean, maybe you'll have a long period of time where prices just don't do anything as incomes grow, right?
That's where I'm at. And again,
Yeah.
the affordability, the Fed broke the housing market. That is what I've been saying for 3 years. And unfortunately, a broken housing market doesn't fix quickly, right? The last time the housing market was this broken was from 1978 to 1994. Now, what the heck happened in those 16 years? In these 16 years, transactions from 1978 weren't exceeded until 1994.
Yeah.
That's because of affordability. People talk about today being the most unaffordable. It's just a lie. 1981 was the worst year. And what we saw over those 16 years was transactions take a hit. That's what people don't get, in my opinion, about residential real estate. Prices are sticky. It's called price inelasticity. And, you know, you don't have to sell, right? You can stay put. You can get roommates if you lose your job. You can do all of these things, not to mention forbearance, right? Should we get into a nasty recession. So I just think, and I've said it a long time, I think we got all of our appreciation in the first 2.5 years, and now we're flat for the next 7.5.
Well, listen, I mean, you can look at markets in general and pretty much say that that's how it works, right? Periods of rapid gains or high returns are always followed by periods of low gains. And it just makes sense because the markets have highs and lows. So
Yep.
it all depends on when you buy. If you buy at the beginning of the cycle, the beginning, whatever your 10-year time frame is, that
Yep.
moving window, right? That it'll depend on what part of the cycle it starts. And if
Yep.
that window starts at the top of the market, you're going to have bad returns for the
Yep.
next 10 years, right? And it's just the way it works. So
Yep.
it may be true that you won't see sort of absolute price declines for single family housing the way that you do for commercial, but you may in real terms see
Oh, for
price
sure.
over time. Yeah, and it'll just have to grow. People's incomes will just have to grow their way out of it. Like I know, what happened in New York City in the 80s. There's a big real estate crash here.
Yep.
And it took years for people to be above water again who bought at the top of the market in the 80s bubble that blew up in New York City. So
Yeah.
people just wind up staying in their houses. If they, like you said, if they don't have to move, they don't. They don't move up to that next house.
Nope.
They, they
Move up buyers out. They're
yeah.
just out.
So that's bad for everybody because nobody's then the starter homes don't open up and
Yep.
what.
Exactly.
But I think
Yeah.
it, you know, the, when we get through this period, though, the housing market will be healthier because if in real terms down payments are a smaller percent, if how many times income now is a house price, right? Like incomes have to catch up
No,
to
I
that.
agree.
And
Absolutely.
low interest
Yeah.
rates are what got us there. And it's
No,
around the world, the same problem.
no, yeah. And again, I just want people to see the bigger picture. I actually have a spreadsheet on my site, onerentalatatime.com, called the 54-year spreadsheet. It has, I think it's like 35 economic metrics all the way back to 1970. So you can go get the spreadsheet, look for yourself, see what happened in the 78 to 94. And the thing that you brought up there is really important because if you look at nominal home prices from 1978 to 1994, they went up over 100% nominal. If you look at it on real terms, it went up something like 12.5% or something. So
Right.
basically 1% a year. But here's the deal. Inflation's a feature, not a bug. So what happens in that environment is your debt, right? If you bought at the beginning of the cycle, 1978, you're paying that off with 1994 dollars. That's an entirely different dollar.
Yeah.
right? So that's the beauty of the 30-year mortgage right there, folks.
Yeah. I mean, that literally is like my dad's house, purchased in 1978 at like some really high interest rate, right? And
Mhm.
then still owns the house today, right?
For him.
He refinanced it at some point when interest rates dropped. But I mean, he was, I remember when he bought it, he was like concerned about how he was going to pay for it. And then within a few years, I never heard him talk about that again.
Yes, oh, we're good. Son,
Yeah.
I'm good.
Yeah.
The rate dropped.
Because his income rose and the
Yeah.
payments stayed the same, you know?
Yeah. Yeah.
So,
Yeah. So it's really interesting. But again, back to this 75 basis, because again, I want to talk about what could happen.
yeah.
Let's pretend that there's, 125 basis point cut. We'll
Yeah.
talk residential and commercial. So residential is easier because so if the Fed funds goes from 5.25 to 4, then the 10-year note today I think is trading at 4.25. It's probably sub 4, I'm guessing. That means mortgage rates, man. Mortgage rates could have a 5 handle on it. 5 handle. And you start getting to 5.5, 5.25. That's going to be almost enough to unlock the move up buyer, right? Because I think we have something like 75% of buyers below 4%. But I know for certain, right? Let's just say you have a 3.99% mortgage. You're in your starter home. You've had one kid, a second kid's on the way. And now the spread between the mortgage you have and the mortgage you can get today is 100 basis points. You're probably making that move,
Yeah.
right? You're taking all the equity from the first home, slamming it into your move up home, and bingo bango, you got another bedroom or two. I mean that could unlock a lot of inventory. That could unlock transactions.
Yeah. And let's not forget
Probably,
in real income growth too,
yeah,
right?
real income growth. Yeah, exactly.
Last few years. So, which is a change from the past,
Yeah,
right?
yep, yep,
Yeah.
yeah.
So that really could affect the market, like you say. I mean, I would agree with that. I don't know if you probably saw this because you see everything, but Fannie Mae came out with their prediction for interest rates, and they're still saying by the end of next year it's going to be 6.2%,
I saw
right?
that. Yeah, yeah.
So they're not jumping on the Fed huge cut bandwagon, right? I
Not
mean,
yet. Yeah.
yeah.
But let's talk about commercial because I think that gets more interesting,
Well, yeah.
right?
I'm sorry to interrupt you.
Yeah,
Yeah.
it just gets more interesting because in my opinion, again, as a complete outsider, some of these things just seem too far gone. But maybe extended pretend saves them. I don't know.
So it's fun to kind of think game this out, right? Because let's just say there's a huge rate cut, right? Let's like that extreme prediction,
Yeah.
125 basis points, right? I think what you will see is uh, the a lot of property coming to market all at once
Mm,
because a lot of these, I mean, some property where they're on floating rate debt, right? It'll certainly ease their burden a lot, and for some property, it'll tick them back over the line. They'll be able to, get
but
above their.
that's margin. That's very marginal, I would think.
I mean, well, what if it was 1.25%? I think actually there's a lot of property that would
Okay.
probably get like they wouldn't be making a lot of money, but they'd be like breathing a lot easier,
Yeah,
right?
they wouldn't be on life support. They'd be breathing on their own. Okay.
Yeah, they might be they might be, properties that are not currently making their debt service might be able to make their debt service. And if they are
Okay.
making their debt service, then maybe, whatever foreclosure might be in the works, the bank might be like, okay, we'll sort of figure out how to make those back
Yeah.
payments,
We're
right?
we're close enough now. Yeah.
Right. And things that are like now in cash management because they're below the DSCR requirement, like suddenly they're going to be back above the DSCR requirements. That's going to be a lot. So I think it
Okay.
would help a lot. But I think you might also, for a lot of sellers who are kind of like white knuckling it and who are not going to be helped by, who are still below the line with a big rate cut, I think all that property comes to market all at once because everybody is going to say, okay, now's the time to sell. The buyers are
Right.
back.
Yeah.
And and
The music started. The music
yeah,
started.
the irony is that rather than fueling a rise in property prices, if enough property comes to market all at once,
Oh,
you
that was
that
exactly what I was thinking. I was like, "Oh my God, this would turn out completely different than people think, right?" Because it's all about
yeah,
supply. If supply comes all at one time, That's you don't want to be
And
a seller in that environment.
right, exactly. And I think you might, and I think a lot of people will all have the same idea at the same time, which is now, okay, whew, like we can finally exit this deal, get our money out, right? And rather than like holding it, which would be the right thing to do if they could. But for the ones that are still below, not making debt service or whatever, they're just going to be like, okay, maybe we can get out, get our equity out or get most of our equity out, and just like, you know, wipe our hands of this thing. I think a lot of people will do that all at once. And then the issue really becomes like, A, if too much supply comes on at once, and then B, what the financing environment is like. Because just because interest rates are lower does not necessarily mean that the banks are going to have an appetite to lend on this stuff.
You know,
Right?
because again, I've seen this movie before. Just because rates are down, the banks, if the banks don't want to lend because, oh, by the way, they're cleaning up the mess that's now in front of them,
Exactly.
it'll be they'll be like, no, thank you, unless you're like 50% LTV or something.
Yeah. Yeah. And that's so I don't think that it will necessarily save things and could actually have the opposite effect. Just in the same way, like by analogy, there's that argument that higher interest rates are actually fueling the economy because now all the people who depend on fixed income,
Yeah,
right, have more money because
yeah.
interest rates they're actually getting paid something,
I have to
right?
tell you, I actually have six figures in a money market making over 5%. I haven't
Yeah.
done that in ever, right?
I
So
mean, if you're doing deals and like, right now you can put all of your renovation funds into a bank account at 5%, it's great. Like, you're
yeah,
making,
why not?
yeah,
Exactly. Might as well make some interest, help pay for that inflation.
yeah.
Yeah, it's
So
crazy. Yeah.
yeah. So I mean, it's so like you said, you might not, be careful what you wish for, right? You
Be
might
careful what you wish for. Yeah. Yeah.
not come up
So,
with what you want.
something we've talked about a lot over the years. You have a lot of experience going on or with Japan.
Yeah.
And I don't know if you've seen this. I'm guessing you have, but the Japanese yen in the last 48 hours, maybe 72 hours, has been getting a lot stronger. I think it kind of peaked out at 162. It's suddenly at 151 or something. Any
It's,
idea what's going on there? Is it government's
uh,
intervention or what?
well, so there's been a lot of talk about the BOJ raising rates finally. So
Oh,
that's
okay.
so like I personally don't want I want the yen to rise, but not yet. I have some reasons for wanting it to stay where it is for the next year, but as usual, my luck will probably not pan out in that way. So, but yeah, this is the BOJ has been trying to support the yen by intervening in the markets, and it hasn't worked. And I think that they're finally realizing that they have to raise rates. Like they're having some big issues there with inflation, even though inflation is relatively low, it's so much higher than it's been for
Yeah.
decades that it is impacting things. They've just raised the minimum wage, and they're having a lot of. So Japan has a big labor crunch because of the declining population, and they've become
Yep.
really dependent on people, moving to Japan from like developing countries,
Hmm.
and but the big attraction for them is the ability to send money home. And with the exchange rates the way they are, it really impacts how much money they can send home. So that's actually depressed the flow of workers into Japan.
Got it.
So that's another reason. So that's also contributing to wages, growing and more inflation. So the Bank of Japan, I think, has finally realized that it needs to raise rates. So
Got it.
that,
That's
that
good.
seems
Just
to,
again, it's an area where currencies is not something I've studied at all. It's a specialty that I don't have. So I appreciate your insights there. Um, I guess let's talk about deal flow. I mean, you and I have been on the sidelines for a long time. You've done a couple of boutique hotels here in the last, I don't know, call it a couple of years. Um, what are you seeing out there? Are you seeing any deals that you're actually trying to pencil and make work, or what is Jonathan seeing these days?
yeah, I'm starting to see maybe, I mean, this may be too small a sample size to be representative of anything, but I've suddenly started seeing a bunch more hotel deals come on the market of the kind of stuff that I like to buy, these mom and pop things. And I don't know really why that is, but
Is
um,
it kind of the red car phenomenon where you're looking, you bought a red car and all of a sudden you see red
no,
cars?
because I've been looking for a while
Okay, all right,
for
all right,
deals, and I mean, I'm looking all the time, but suddenly like a bunch of things have popped up that, we're like, huh, this is kind of the thing that I like to buy.
okay.
So, but if if there is any kind of theoretical reason why this might be. It could be that people have tired of waiting and they're
Yeah.
just ready to go. They're just like, people who
Well,
want to.
this is back to the earlier point. I want rates to stay high so I can find the motivated sellers. At some point, they're like, I'm 81 years old. I've got a decade left to go. I'm out of this thing. Give me my number. Give me my seller terms. I want to go on a cruise ship for
Yeah.
6 months out of the year. I mean, at some point, you just sell.
Yeah, that's exactly what I'm seeing. I'm actually I bid on one and I'm about to bid on two more. All three of them are
Wow.
motivated sellers. I mean,
I love
interestingly,
that.
different motivated sellers. One is actually a corporation. One is a mom and pop that they just want to retire. And the other one is a guy who bought a hotel that had no business buying a hotel. And
I love motivated sellers. That's where wealth is made, man.
yeah,
Right
and he,
there.
and he just wants out, right? He did a 1031 into a hotel and realized like, hey, this isn't my thing. So he's
Right.
selling after a year. And this is great. I love it. I mean, I want this to continue. Because all of these people are reasonable about what they're selling, and
Mhm.
they understand the market is what it is, and
Yeah. Yeah,
so
if you get 125 basis cut in rates, they could change their opinion. They could be not
yeah,
as motivated.
yeah, and but here's the thing though, like there was some chatter today that on LinkedIn that people were saying, man, this reminds me of last year, like nothing's happening because everybody's waiting for this rate cut now all of a sudden. And I think
Yeah,
that
it's
like,
true in residential. I talk to agents every week. I actually said on my audience that a buyer's market's returned.
yeah,
We're now over 4 months supply. Nope, it's dead. Open houses aren't going. I think the consumer's like, I'm out. This freaking environment's crazy. We got an election coming. It's toxic. I think the second half is going to be extremely slow.
yeah, I mean, could well be. And just on the topic of the election, like I have just really never understood this phenomenon, like people not making economic decisions because of the election, like as if that's going to really change anything, like it never really does, right? I mean, maybe taxes go up, taxes go down, but like nobody should making investment
Mhm.
decisions based on taxes anyway. So I've
Yeah,
never,
I've studied this for years. It comes around every 4 years, so the
yeah,
economic data is pretty dependable. I think unfortunately, this election is unique. We're coming off eight other years that were fairly stressful. The election cycle. This one's year 12 of this, and I think half the country doesn't like the other half. It's pretty toxic. It does feel like that is being tempered a little bit, which is great. We don't need to we don't need all this hatred. Let's go to the ballot box and let's just get forward. But yeah, dude, I think consumers tapped out. I'm like, yeah, I think the consumers. I'm just gonna wait. I mean, why would you buy a house today? Right? Would you sign the biggest purchase of your life when you're scared, pissed off, nervous? I mean,
well,
it just doesn't happen.
yeah, well, no, I understand the psychology of it, right? That makes sense. Well, I don't understand the effect of the psychology. I guess I don't understand the psychology necessarily because it does, especially on the commercial side of things.
Yeah, true. That there
Qualify,
should be very different. Should be
but
numbers.
like
Yeah.
on the commercial side of things, it seems like it doesn't really make any sense, like to be making investment decisions about like or like holding off because then because this is what inevitably happens. So for the half of the country that doesn't like the way that the election comes out, do they stop investing after the election? No, they just go back
No.
and start investing again. So like it doesn't. This is the thing that doesn't make any sense to me. If they were all if like half of the country was like on the basis of the election, like okay, we're packing our bags and we're you know
We're leaving. We're moving to Europe or whatever.
we're
Yeah.
moving to wherever we're moving, right? We're moving to Costa Rica, where it doesn't matter. Like then I get it. But the fact of
Yeah.
the matter is everybody's like, oh, the election, oh, the election, oh, the election.
Yeah.
And as soon as the election happens, they just go and do what they were going to do anyway, no matter who gets elected. So
Yeah.
this is why I don't understand, especially for the commercial, the professional real estate market.
I agree. I did not realize, nor have I. I've always looked at residential. I don't understand why the commercial would give a make why they would have one data decision because of that. I mean, whether it's listing or buying.
Right.
I
But
think you're right.
even for regular folks, like I don't really because they're not because what's going to happen? Like if Trump gets elected, is no Democrat going to buy a house for the next 4 years? Well, I mean, like it's just right. That's not. It's
Yeah.
actually no. Like that's not going to happen. right? The number of people who will not buy a house because Trump gets elected are zero. And the other way
Mm,
around too. If Kamala Harris gets elected, the number of Republicans who are not going to buy a house for 4 years, zero. None of them,
mhm,
right?
yeah.
So what are they worried about? I don't get it.
Blame social media. Blame the media. At the end of the
But
day, the media is spurred up. Once you get emotional and
yeah,
it's raw,
yeah.
logic goes out the window.
People think the end of the world is going to happen one way or the other. And
Negativity sells, man. Gets clicks. Yeah, a lot of stuff, a lot of exciting stuff. At the end of the day, I think in residential, we're entering a buyer's market. I think we've already been there in the commercial space. I'm excited for the next 6 months because not only will I compete on price, but terms are going to get a lot easier to get in this environment. So I'm excited about the next 6 months. Jonathan, close us out. Where can they find you?
yeah, so listen, these days very active on LinkedIn. If you want to come and start a conversation with me, follow me there, hear my thoughts. That's probably the best place to go. You also can join my investment, mentorship program at apartmentinvestorsclub.com, or just reach out to me on LinkedIn and I'll send you the link.
There you go. Jonathan, you're amazing. Thanks, buddy.
Thank you.